Okay. Good morning, all of you. Some of you might recall that last year we also had a charterers panel. We were trying to repeat it this year, but unfortunately there were two panelists who couldn't make it. So together with Capital Link, we decided to mix and rumble a little bit and invited some good friends to this interesting part. We have, I don't think, need a lot of introduction. We have Kenny Rogers. He's the head of Aurora Tankers. That is the tanker owner and operator arm of IMC, based in Singapore. Bjorn Stignor. He is the general manager of Golden Stena, which is a joint venture between Golden Agri Resources and the well-known Swedish Stena group. Pankaj Khanna, well-known in Singapore, ex-CEO of Pioneer. He works now with TMS, which is George Economou Group in Greece, in sunny Athens. And of course, Michael Nagler is the head of chartering of Noble. I think we're all familiar with Noble in this part of the world. Yeah, then maybe a short kickoff, a short introduction on the topic, which the title of this 30 minutes or 35 minutes panel is the global shipping, commodity and energy markets, ship owners and charterers perspective. Fossil fuel is still 85% of the global energy mix, though renewable energy growing fast, but from a pretty low base. Oil is still 34%, coal 28%, and natural gas 23%. Energy commodities represent almost 40%, 40, of all global total global seaborne trade, which is approximately 4.5 billion tons. So all these commodities will remain a very major backbone of our global seaborne trade. So I think with the panel we have here, charterers, ship owners, both active in the dry and in the wet. I think it's time for my first question. Where do you see the major growth of commodities in this part of the world for the next few years? Pankaj, you are very eager.
Okay, I can...
Oh, Kenny, you jumped the queue.
Sorry.
Go ahead.
Well, I can speak more to the chemical side. If you look at Asia, look at the production in the Middle East, certainly growth in the chemical production is moving ahead. Chemical demand is really, chemicals being more of an industrial product based on consumer demand. I mean, we see in the future, of course, consumer demand is based on population growth. These areas in Asia, of course, population growth is moving ahead. In India, China, Indonesia, the rise in middle class in India is quite positive for the chemical side because more goods are being demanded. And of course, China continues to be an industrial engine that requires chemical feedstocks. So that part of the picture is still very good. The unknown picture is the other part of the commodity business that we have to trade in is CPP. Clearly, it's a question mark now, and with 90 MRs being delivered in 2019, the highest amount of MRs being delivered since 2008. That could put pressure on our business because chemical tankers usually need a positioning voyage, and that's our positioning voyage. Okay.
Okay.
I think from my standpoint, the most exciting sector right now is LNG. In our group, we have just last year ordered 11 LNG new buildings, and that is obviously on the back of increased consumption in Asia in the main. Asia remains the major import center for LNG, The other exciting element in LNG is, of course, the increased ton mile. The US has turned out to be an increasingly important exporter of LNG. There are a lot of new plants that have been set up, liquefaction plants, in the US Gulf area. And we see that ton mile impact that will come through in the next couple of years. Also, there are a lot of new projects which are coming up. Qatar has already announced expansion, Tanzania, Mozambique, and elsewhere. So I think if you look at shipping, LNG is probably the commodity with the strongest growth.
Okay. Michael?
Yeah, thank you, Frans. We see grain, as Kenny mentioned, there's an emerging middle class. We're seeing eating habits changing across the region, which mean a greater demand for grain. So grain will be positive. Coal, which is a bit of a dirty word, but we do see quite strong demand the next couple of years for coal. And renewables, I mean scrap, we see that as a trade that also will pick up. So it's not all gloom and doom, especially for the smaller types of ships, Supramaxes, Panamaxes, in our mind, they will benefit from these increases, especially on the grain. South America, China, long-haul business.
Okay.
Yeah, so I don't think there is any problem with growth in the commodity space. I mean, oil is growing, dry cargo is growing, LNG is growing. Myself representing Golden Nagler, which is Indonesia's biggest palm oil producer. So I guess that is biodiesel. I think about 80% of all palm oil goes to food, and the rest is cosmetica and nicer chemical and biodiesel. So I think if we talk growth for my sector, that will definitely grow because the palm oil production will increase faster than the food demand. So more and more palm oil will go to biodiesel around the world. And already today, we see big shipments into Indonesia, Malaysia on the diesel blending. And I think that will happen more in China and India. If not for environmental purpose, it's also for biodiesel is cheaper than diesel at the moment. So it's happened naturally.
And how important is the Asian region for your business? Michael, maybe you.
Yeah, I mean, we're based in Asia, and Asia is our biggest market, and that's where our focus lies. So, France, that's our business. That is Asia, and that's where we see the growth. In short.
Okay. Any different views from the panelists, or do you all agree?
I think if you look at whether it's crude, for example, 52% of the global seaborne crude trade is Asia-centric, 44% of the grain, 88% of iron ore. So if we're talking about commodity movements, Asia has to be the most critical region for us.
Yeah, just one more comment on the chemical side. I mean, there's always a mystery to the chemical business. It's a parceling business, but not necessarily true. 107 million tons of chemicals will be transported by sea in 2019. 60 million of those tons are three products, are methanol, paraxylines, and glycols. So it's interesting to note that when people think of the chemical business, they don't relate it to a commodity business, but it's really a commodity business when you look at that statistic. Large volumes of these three chemicals are being moved, which can change the dynamic of the whole business because traditionally the chemical business are smaller ships, parceling ships. So there may be an interesting dynamic that's happening here in the future in what chemical ships are really needed for the trade.
Okay, thanks, Kenny. Staying with Asia, but then branching out to globally, to Africa, to Europe, to Italy, to Greece. The much described and debated One Belt, One Road initiative. Do you see any impact on your business, on your trading patterns, on the strategy of your own company? Bjorn?
I'm sorry to say that I don't think there will be a big change for the palm oil industry with One Belt, One Road. Asia is already the strongest market, India, China. So Of course, it will open up new possibilities, but not a big changer. Maybe more for dry cargo, I don't know.
Yeah, and not really. I mean, I think it's more a container issue. You know, if you're in the container market, then obviously there will be a big impact because you'll see more flows come across land. But for us, we don't see big dry bulk movements doing that, and currently we don't see the impact.
Pankaj? No?
I agree. I don't see anything in terms of direct impact on the trades.
Frans, one thing I'll just, sorry to jump around a bit.
No, go
but,
ahead.
But in terms of Asia being, you know, sort of the place to be, I would find it difficult as a shipowner if I was based in Europe. You know, there's so much intelligence out here. So if you're not based in this part of the world, in my mind, you are handicapped.
Based as being not having a representative.
Yeah,
of
right.
us here,
Exactly.
okay.
Exactly. I think Singapore has become over the last 10 years. You know, if you're not here, you will be handicapped. You won't get the same inputs.
Yeah, I mean, I would comment on a one belt, one road. When you look at it, it's a massive, massive undertaking. It covers almost over 60 countries. It could impact the world GDP by almost contributing almost 1/3 of trillions of dollars. But the more important thing to look at here is the Chinese, behavior of the Chinese. The Chinese are very smart. They're controlling a lot of infrastructure. They're putting their footprint in places that they haven't been there before. So this will certainly strengthen, China, because most of the infrastructure, no matter where it is going to be controlled by the Chinese. So it's quite fascinating how they've quietly moved through this. Some countries have been politely pushed aside, one being Singapore, I believe, and Malaysia. So there's a whole change in logistics and structure coming on the back of the Chinese involvement.
Yeah, we're seeing that in my other role as a shipping banker as well. I mean, how fast that landscape has changed, but maybe that's for later. Okay, sticking then, of course, it's a bit obvious if you're based in Singapore and talk about Asia that China is a main topic. The slowdown in China, is that any impact on your business? Where do you compensate cargoes from, or not at all?
Yeah, for us, it certainly has had an impact, and we are now shipping. We're seeing an increase of our commodities moving into India instead. So India has replaced China on some of our flows. Having said that, we are seeing China coming back, but there's been a patch.
On the energy side, we haven't really seen China slow down. Crude imports are still very strong. LNG imports have been rising at an exponential rate. So on the energy side, I don't think that we have seen an impact of the slowdown as yet. But of course, recent numbers on car sales have been a bit slower, so that will eventually filter through. So maybe that's not a 2019 event, but could be 2020 where we see demand growth slow down a bit.
Yeah, I don't know if 5% is a slowdown really compared to Sweden, where I come from. I was checking before. I couldn't find any year we had 5% growth this century at least.
Actually 6.5.
Okay, there you go. But for palm oil, it's been great. Thanks to Kenny's president, Donald Trump, and thanks to Canada arresting Huawei CFO. Meaning China stopped canola oil import to a big extent into China, which means more palm oil are being shipped to to China. So it's been great for us, the war.
Chemical tanker market definitely had impacted us in the U.S. Gulf to Far East trade, thanks to the policies of the United States of Trump. However, fortunately, we'll be able to shift our tonnage over. Once again, China is quite resilient, can source from many different sources. So whatever chemical deficit that they had to absorb because of their tariff activity by the U.S. was readily supplied from the Middle East. So actually, our Middle East business has gotten a benefit from the Trump war, and the Middle East trade is actually more efficient for us than the U.S. Gulf trade. So all things being equal, this has really helped us to redeploy vessels to more efficient trade lanes.
How's that for you, Michael? The U.S.-China trade war? Negative, positive?
Negative. But we feel confident that a solution will be found, and the wheels will turn again. But sure, negative short term.
Yeah, I mean, obviously it's a negative short term because China's not buying as much LNG from the US or as much crude oil. But once that situation flips, we think that the solution for the trade war is that China will buy more energy from the US. And that's obviously great for the shipping markets because it's all long haul and a much larger ton mile impact than the shorter haul sources. So I think the resolution of the trade war will be a big flip to both the LNG and the crude oil trades.
Okay, good. Looking at the clock, we are more or less halfway the time we have been allocated. So I would like to shift a bit more towards topics related to the charters and the owners. A question maybe for you. How do you select ship owners to charter in vessels, and how do you manage the counterparty risk? Michael, as charter, you're also ship owner, but you're on both sides.
No, sure. So we use, first of all, we obviously have long established relationships where we obviously know who we're dealing with. If it's new counterparties, we screen them financially. We use a company for that. On the technical side, we use another company, RightShip, where we check the structural parts of the transport, and we do that rigidly. So, knock on wood, we have avoided any significant issues. But that's a key. If you don't do that, you will end up in having problems.
How many vessels do you charter in?
We chartered, so last year we chartered, we moved 28 million tons of cargo. That's 500-600 ships.
Okay. Bjorn, on your side?
So we move about 6 million tons of palms, and we charter about 300 to 350 vessels. Our biggest supplier of ships are Shell, Cargill, and Coke. So interesting enough. But of course we do a strong vetting on our vessels as well. Although palm oil still doesn't need any SIRE or CDI. I think Cargill is the only one who is screening vessels. But I think we will start doing it in course of this year, probably with RightShip, and start to try to improve the quality of the ships. However, in our shipping world, a lot of the ships that we use are repetitive, doing the same kind of business, palm oil only, for example. So the history and knowledge about the owner and vessels are quite strong in that sense. And supposedly we are in a good economy, so no one should go default as of now, right? So we have to wait until the world collapses.
And Kenny, do you think these guys are too powerful, the trading houses, the cargo owners?
Yeah, well, certainly the whole dynamic of the chemical business has traditionally been driven by COA business, by COA contracts. Because as you know, it's a win-win for the producer, the traders, and the owner. In the past, it's been a win-win. However, these type of agreements have eroded in the last couple of years because of the down market. And unfortunately, it's not such a win-win anymore for the owners. Traditionally, knowing that the chemical tankers are very specialized, that these aren't market-ready ships, market-available ship, there was a benefit, of course, to the cargo interest. But now in a down market, some of their clauses and, for instance, quite readily we see charterers that are offering no minimum cargoes, which is very, very unusual. A couple of years ago, you wouldn't see this. Erosion in freight rate. So So the dynamic is changing to some extent that, I think many other chemical owners, not only ourselves, are rebalancing their portfolio, not moving away from COAs, but rebalancing their COAs to make sure they're in a more favorable position and not held hostage by poor rates and poor terms. The terms are also very important. It doesn't matter if you secure a high freight rate, but you don't have any minimum. So basically you have air. That's all. So it's a situation that's evolved because of the down market, more tonnage in the market, but hopefully we'll see it come back when there's more production online in the U.S. Gulf and the Middle East in the next year or so.
Pankaj, any views on this?
Well, it depends on the sector, but ship owning is so fragmented. We have no pricing power in this industry, and I don't think we will ever get that. And then our customers have been consolidating and becoming larger, so obviously their pricing power is increasing, or their power to control the market is increasing. From the ship owner side, the only thing we can do is consolidate ourselves. So I think some of the financial players are driving that consolidation. So you see that the tanker companies, especially the public companies, are becoming larger, and we're seeing that on the dry bulk side as well. And then there is also, of course, the route to go into pools if you want some consolidation in that sense from the commercial side. But this is the thing that we have lived with for the last how many ever years, and it's something that we'll see going forward. But we cannot remain as fragmented as we are today. Things are changing from the customer standpoint, and if we stay as fragmented, we'll lose even more what little pricing power we have, which is virtually negligible.
Yeah, I agree. Okay, maybe now to another topic.
Sorry, can I follow up on that
yes,
one? Because I think there's always that you got the evil big charters here, and then you got the owners on the other side. But I think that's slightly misleading. I mean, it's a partnership where it should work in partnership, and no company is bigger than the market. The market is the market. So, in my mind, no, big charters are not too powerful because there's not only one charter. I think there's a slight sort of perception that if you're a small ship owner, then you're being exploited by the big charter. On the contrary. And I think it's important to have that sort of relationship, because otherwise, as soon as you have an issue, then it's difficult to solve if you have that mindset.
Yeah.
And I mean, 2/3 of our business is third-party business. And we're ship owners as well.
Yeah. So the long-term relationships is definitely a key part here.
Yeah, no, sure. I mean, it certainly improved, but when I started in shipping a long time ago, it was very confrontational. And there's no need for that.
Okay. Staying to the charter's perspective, as you know from the trading houses, a number of them own their own fleet, such as Glencore, Trafigura, Vitol, Gunvor. Some of them not 100%, but in joint ventures with owners. I think especially in Greece there are some joint ventures with trading companies and owners. And other trading companies like Koch, Cargill, and Mercuria, they seem not to be investing too much in own vessels. What is the view of the panel? I mean, for a large trading company to invest in steel, in long-term assets, should they do that or not? Okay, you both have it, so the answer is most likely be yes.
No, I mean, every trading company should have their own ships. It makes complete sense. By being a trading company, you see the commodity flows. You have a much better handle on the supply and demand picture. So you are ahead of the traditional ship owner. You know what's going to happen, or at least you have a much better idea. So it makes complete sense to own ships. Unfortunately, a lot of trading companies they don't put enough value or emphasis on the shipping part of it. They just think, well, the ship's moving bits and pieces around. But the knowledge that a trading company's got is significant.
I mean, when I started in shipping, whatever, 20, 30 years ago, there was a lot of old classic ship owners like Stena, for example. And today, as you were saying, I mean, our biggest customer on the palm oil side is Shell, who I think have 65 MRs and have new orders coming, right? Although they don't own them, they have done financial deals on them. So I think from a ship owning perspective, it's absolutely horrible because the trading companies, they will control the market. Yeah, you know, yeah, they like the market to go up, but they also like the freight to be fairly stable. So I just wonder if, you know, how will the future look if we talk about that? Will the future be that ship owning is a commodity itself and you have, you know, financial deals only and the traditional ship owner disappear, or will the traditional ship owner come back? And I think as long as we have this many shipyards, it will be a tough life to be a ship owner. That's my conclusion, because the trading house will just have enough tonnage to control the market themselves. Chemical has not happened really, but palm oil swings between the product fleet and the chemical fleet, so I can see that clearly.
Yeah, the question is, you know, where have owners, even the chemical side, are impacted, especially by some charter-in tonnage and new buildings by some of the major oil companies. And the question really is where have the independent owners failed in not providing assurances or providing assets that would give you know, stop oil companies from building their own ships. Something's happened somewhere where maybe we have failed to give oil companies assurances not to build their own ships.
So,
I don't know what that answer is. Something, there's something not right, you know.
okay. Maybe a bit of an open question. Nicely introduced by Kenny. What do you see as your major threat going forward? What is your biggest concern nowadays? Let's not talk about scrubbers or ballast water treatment or... Kenny?
Events. One of my colleagues today at coffee, we were talking about our inability to forecast correctly. So I think this is an industry-wide problem. And he mentioned it's because of events. Quite interesting. How do we measure events? How do we predict events? But geopolitical events, of course, are a major threat to being able to you know, forecast your future. I mean, every day there's some type of political event happening, whether it be Venezuela, Iran, the basic destruction of the ITC terminal in Houston. That's an event. So many events impact our business, and how do we predict this? That's a major threat to us in the future.
Okay. Bjorn?
I think the biggest threat is the shipyard capacity. So, I mean, as a charter, of course, it's nice to have too many ships to choose from, but ultimately we want to have a stable platform of ship owner that we can choose from, that we know are sustainable and can survive the climate. But with all this shipyard, and we can already start to see it in Japan, you know, look back in history, even my own country, Sweden, in the 80s, the government started to build ship just before they went bankrupt. And it will totally saturate the market with ships. And although we have had such a good growth on commodities, we still doesn't have a shipping market that is super firm, which it should be. So I think shipbuilding capacity is a problem. And as I said, I think we can see it in Japan already start happening, where the government or the shipyards themselves will start building, which is a worry. And that will put a lid on the market for a long time.
I would say we've been very fortunate, you know, although you said scrubbers and we should not talk about it, but thank God for the scrubbers, because so much of the capital has gone into that investment that that would have probably gone into new buildings. So fortunately for us, the supply side over the next 1 to 2 years is manageable. What will happen if the markets go up is another matter. So really what I see as the biggest threat right now is a concerted slowdown in the global economy. And we are starting to see indicators across China, Europe, and the US, which suggests that some form of a downturn is coming. Whether that slows down the growth or whether it takes it into recession, we don't know. But there are signs on the horizon that the economy is starting to look a bit weak.
Okay.
Right, okay, we only got 4 minutes and 36 seconds. So, but it's a long list of various things which the other guys have mentioned. But for me, I think the biggest concern is we're entering an environment with short-term thinking. That is a different mindset, which potentially will change things dramatically. And that comes to relationships, it comes to shipbuilding. People will not think long-term. It's all short-term fixes to make it look good short-term. So that's my concern.
Okay, maybe my last question before we open up the floor for some questions is going back a little bit to Bjorn about shipyard capacity, prices. Is it a good time to order new ships or not? Or should we refrain? We should, of course, refrain, but...
Well, I guess a ship owner is always an optimist, right? So the prices are a bit high at the shipyard still. So I only know the wet market product and the chemical. So I would wait a little bit, at least in that segment, to build. I agree with what you were saying, that there is less new building coming, so it looks bright. But I'm coming back to the thing, why don't we let the market come up first before we kill it, right? And have 1 or 2 good years. Why start building now already on something that we think will happen? So ultimately, no, I think we should not build any vessel. I think we should let the shipyard go busted and then enjoy the market later.
Kenny?
Prices are going to increase, clearly. Price of steel is going up, price of labor. Also, more importantly, that people don't discuss is governance by the Chinese government. So, for years and years and years, Chinese built ships with no margin. But I can see the trend now is that there's more control by the government to ensure that if they build ships, there must be a margin in the project, which will significantly, not significantly, but certainly is going to increase the pricing.
Yeah, I'll just add one thing. The shipyards haven't really, on the dry bulk side, haven't adjusted the price in line with the market. So we have the standoff situation. So the current prices that the yards are offering too high. But once they adjust, which they have to, otherwise they're not going to attract any orders, then we see it in the dry bulk segment on the smaller sizes as an interesting entry point.
Yeah, I mean, don't really see the need in the dry bulk or the tanker sector. I mean, you can see where the markets are. Obviously, we are well supplied, and every barrel that needs to be moved is being moved at rates which are competitive, and the same thing can be said for the dry bulk. I think the only place where I see the need is on the LNG side. The order books are already at 25%, but if you look at what's coming in the pipe from the liquefaction standpoint, I think we will probably see another 100 ships ordered over the next year or so. That's the only place.
Okay, then I have exactly 1 minute and 20 seconds left before the hard stop.
Any question?
If not, then thank you. We rushed through a lot of topics from commodities to trade flows to trade wars and issues related to owning or ordering. So thank you very much, my dear panel, and until next year.
All right.